We are told the global economic order rests on a foundation of solid physical wealth. To guarantee their massive fiat currency supplies, the world's most powerful nations supposedly hold thousands of tons of pure sovereign gold in secure government facilities. Take the United States Bullion Depository at Fort Knox. Officially, this military compound in Kentucky holds over 4,500 metric tons of sovereign gold. It is billed as the largest single cache of government bullion on the planet. But despite its status as the bedrock of American wealth, Fort Knox has a glaring omission in its record. It has not undergone a complete independent physical assay audit in over 70 years. The last partial audit occurred in 1953 during the Eisenhower administration. Even then, auditors did not test every single bar for purity. They failed to melt down samples to verify that the gold was genuine, rather than tungsten pores wrapped in a thin layer of bullion. Since then, multiple members of Congress have introduced legislation demanding a full, transparent inventory of the vaults. Every attempt has been blocked, or endlessly delayed, or classified under national security exemptions. If a superpower refuses to prove its gold exists, it suggests the reserves are not being kept as a static store of value. Instead, the gold is being treated as an active financial instrument, one that may exist more on balance sheets than in the vaults themselves. In the physical world, an ounce of gold is a tangible element. If you hold it, no one else can. But inside the banking matrix of the London bullion market and the New York COMEX, gold is often handled as a digital derivative. This is the mechanism of unallocated gold accounts. For every single physical ounce of gold in an institutional vault, financial institutions trade an estimated 100 to 200 paper claims on that exact same ounce. Investors aren't assigned a specific bar. They hold a contractual promise that the bank owes them metal. Banks can take the physical bars and lend them to short sellers at low interest rates. Those borrowers then sell the physical gold into the open market. By flooding the supply of physical metal while keeping the paper claims on the books, banks can artificially depress the price of gold. This makes unbacked paper currencies appear stable and valuable in comparison to suppressed precious metals. But this leverage creates a mathematical vulnerability. If even 5% of paper gold investors simultaneously demanded physical delivery of their metal, the entire fractional bullion market would face immediate insolvency. Sovereign powers have used physical bullion to protect failing monetary systems before. In 1961, facing a run on American gold reserves, the US and 7 European central banks formed a secret cartel called the London Gold Pool. To keep gold at exactly $35 an ounce, the cartel dumped sovereign stockpiles into the London market whenever prices threatened to rise. They burned their physical reserves to maintain the illusion that the US dollar was as stable as the metal itself. By 1968, European nations, most notably France, observed their own sovereign reserves being liquidated to subsidize the value of the dollar. In response, France sent naval warships across the Atlantic to physically load its gold reserves and take them back to Paris. The London Gold Pool collapsed, leading directly to Richard Nixon closing the gold window in 1971 and ending the dollar's direct convertibility to gold. A historical rule was established. When central banks need to hide currency inflation, they will quietly exhaust physical reserves until the market forces their hand. For decades after, foreign central banks continued to keep their gold inside the underground vaults of the New York Federal Reserve and the Bank of England for safekeeping. That trust broke when Germany's Bundesbank requested the return of half of its 3,000 metric tons of gold from New York. What should have been a routine shipment turned into a diplomatic standoff. The Federal Reserve stated it would take up to 7 years to fulfill the request. Why take 7 years to move metal supposedly sitting on pallets? This gap suggests the gold wasn't immediately available. If the bars were leased out or remelted for trade years earlier, the vault would be effectively empty of Germany's specific holdings. In this scenario, the Fed would be forced to gradually reacquire physical bars from open markets, pacing their purchases out over several years to avoid triggering a sudden and violent spike in the global gold price. Germany's 7-year wait served as a warning to other nations. Holding your gold inside another country's vault creates a massive geopolitical liability. That warning triggered a silent panic. Central banks across Asia, Eastern Europe, and the Middle East are now pulling their physical bullion out of Western vaults at the fastest pace in modern history. Nations like China, Russia, and India are bypassing the Western paper gold market entirely to build their own asset-backed infrastructure. They are no longer buying paper contracts on the COMEX. Instead, they are settling for direct physical delivery through dedicated exchanges like the Shanghai Gold Exchange. These nations are designing cross-border digital payment networks to settle international trade and oil contracts in local currencies, backed strictly by their physical gold reserves. This shift represents a rejection of the unallocated paper system in favor of a model where ownership is defined by physical possession. The Western system of unallocated ledger claims is now being challenged by the physical settlement infrastructure built in the East. This transition marks a global shift away from digital promises and back toward the verified exchange of physical assets. When the modern financial system resets, survival will likely belong to the nations that can open their own vault doors and prove the gold is actually there.